If you clicked this because the title says Michael Saylor, I've never seen a setup like this, then here's the uncomfortable part right up front. Bitcoin is still down about 30% from its peak, and if you're judging what just happened by that single number, you're already measuring the wrong thing. And the cost of that mistake isn't emotional, it's financial. Because while most people have been staring at a flat, frustrating chart, something irreversible has been quietly locked in underneath it. That's what pulled me into this. Not the price, not the headlines, the disconnect. When Bitcoin chopped sideways for months, a lot of smart people started saying the cycle topped, the trade was crowded, the thesis was tired, and at the exact same time, Michael Saylor kept buying. Not talking, buying, not hedging, not slowing down. And that leaves you with only two possibilities. Either he's completely lost touch with reality, or the rest of the market is focused on the wrong signal. I want to walk you through how I tried to answer that for myself, because once you see what he's actually reacting to, you can't unsee it. And it changes how you interpret everything that happened this year. Most investors, even experienced ones, evaluate Bitcoin the same way they evaluate a stock. One number. Up means good, down means bad, sideways means something's broken. That framework feels logical, but it only works for assets where price is the main driver of adoption. Bitcoin isn't that. Bitcoin is infrastructure pretending to be a trade, and infrastructure behaves differently. Here's where the investigation started for me. Every prior Bitcoin cycle followed the same rough sequence. Price runs first. Everyone scrambles to explain why. Then, years later, the plumbing shows up. Custody improves. Regulation slowly forms. Institutions finally feel safe enough to touch it. The foundation always lagged the chart, but this time, something felt off. Price didn't lead. Price stalled. And yet, the list of structural changes kept getting longer. Not hype, not promises, actual switches flipping. So I went back and listened carefully to how Saylor talked about this year. Not the clips that get passed around, the longer answers, the boring ones, and that's when the setup snapped into focus. He wasn't defending the price at all, he was dismissing it, and instead he kept pointing to fundamentals that most traders don't even track. Think about what that implies. If price action is noisy, but the foundation is advancing, you don't get a slow repricing. You get compression, pressure builds, and eventually it releases. Here's the first thing most people missed. For the first time in Bitcoin's history, regulatory clarity came before the next price leg, not after it. That sounds abstract until you sit with what that actually unlocks. For over a decade, Bitcoin lived in regulatory limbo. Banks couldn't touch it without career risk. Large institutions couldn't use it as collateral. Credit markets couldn't form around it. Not because it wasn't valuable, but because nobody wanted to be the first one standing in front of a regulator explaining why. That changed. Quietly, but decisively. You now have a broadly supportive regulatory environment across the major agencies that matter. That's not politics, that's plumbing. When regulators stop treating Bitcoin like an unresolved problem and start treating it like a defined asset, entire categories of financial behavior turn on. This is where Saylor's framing matters. He's not talking about sentiment, he's talking about mechanisms. Mechanisms don't care if you're bullish or bearish. They don't care about fear or excitement. Once they're live, they just operate. Let me slow this down, because this is where the setup really forms. Bitcoin produces a fixed amount of new supply every day, roughly 450 coins. At current prices, that's around $40 million of natural sell pressure hitting the market daily. Over a year, call it $16 billion. That number sounds big until you place it next to how modern credit works. In traditional finance, supply doesn't get absorbed by buyers saving cash. It gets absorbed by credit creation. A single large bank can create more than $16 billion of credit in a year without breaking stride. Now here's the key shift. For the first time, banks are being cleared to issue credit against Bitcoin itself, not proxies, not workarounds. The asset. When that happens, the math changes instantly. Every $16 billion of Bitcoin-backed credit removes an entire year of mining supply from effective circulation. And that's not theoretical anymore. This is where I had to stop and rewind, because this is the part that doesn't show up on a chart until it's too late. Credit doesn't arrive gradually. It arrives in blocks. Allocations, balance sheet decisions. When a $1 trillion institution decides Bitcoin is acceptable collateral, it doesn't test the water with $10 million. It moves in size, and it does it quietly. So ask yourself this: if you're watching price chop sideways while that infrastructure is being built, are you early or are you blind? Another piece that changed everything this year was how Bitcoin connects to existing financial rails. Spot ETFs are an easy headline, but the real shift was how they were structured. In-kind creations and redemptions mean Bitcoin can move in and out of these vehicles without being forced through cash markets. That matters because it allows institutions to swap, borrow, and rehypothecate in ways that were impossible before. Again, not exciting, but transformative in effect. And that distinction matters more than people realize, because the most important shifts in markets almost never feel exciting while they're happening. They feel administrative, they feel slow, they feel like paperwork, and by the time they feel exciting, the opportunity has already moved. And then you layer in derivatives, and this is where the story really changes. Offshore crypto markets have driven Bitcoin's price for years through leverage. That's been the engine. Perpetuals, high leverage, fast liquidations, short-term positioning overwhelming everything else. That's why price could move violently with very little underlying change in adoption. What changed isn't that leverage disappeared, it's where it's moving. Regulated onshore derivatives are now expanding fast, and more importantly, they're being plugged directly into traditional margin systems. That's not just more volume, that's a different class of participant entirely. These are institutions that don't gamble, they hedge, they manage exposure, they integrate assets into portfolios that already exist. That sounds technical, so let me strip it down. When Bitcoin only trades in crypto-native venues, it behaves like a speculative instrument. When Bitcoin trades inside regulated derivatives markets, it starts behaving like a financial primitive, something that can be priced, margined, netted, and reused. Here's what that means in plain language. Bitcoin is being pulled into the same machinery that already drives commodities, currencies, and interest rates. The same pipes, the same risk engines, the same collateral frameworks. Once an asset enters that system, it stops being judged solely on price volatility. It starts being judged on reliability, liquidity, and collateral quality. And once that happens, it doesn't sit still, because collateral gets used. That's the entire point of collateral. It doesn't just sit in a wallet or a vault. It gets pledged, it gets rehypothecated, it gets embedded into credit relationships. And every time that happens, available supply tightens. Not because anyone is trying to cause a shortage, but because the asset is doing its job. This is why Saylor keeps saying most people are measuring the wrong thing. They're watching a price chart and asking why nothing is happening, while the asset itself is being rewired underneath them to function in a completely different financial role. And this brings us to the part that made me uncomfortable when I first really sat with it, because it forces a reframe that most traders don't like. Roughly 85% of Bitcoin is still held by long-term holders and traders who genuinely don't care about any of this. They don't follow regulatory memos, they don't care about accounting treatment, they trade leverage, they fade rallies, they provide liquidity. And for most of this year, they completely dominated price action. That's why nothing seemed to happen on the chart. Not because Bitcoin was broken, not because demand disappeared, but because the marginal price was being set by participants whose incentives are short-term by design. But here's the part that changes the outcome. And it's subtle. They don't need to care. Once Bitcoin becomes usable, accepted collateral inside regulated systems, their holdings become relevant whether they opt in or not. The repricing doesn't require their participation. It happens around them. Their Bitcoin becomes part of the supply that institutions build on top of. This is why consolidation during infrastructure build-out isn't bearish. It's suppressive. It compresses volatility. It keeps price contained while the mechanism is being assembled. And that delay is exactly what makes the eventual move so disorienting. In every previous cycle, price ran ahead of fundamentals. Speculation first, infrastructure later. Everyone knew the pattern. This time, it inverted. Fundamentals ran ahead of price. That inversion is rare, and when it resolves, it doesn't do it gently. It does it abruptly, because markets have to catch up all at once to something that's already real. I want to pause here and insert something important before we go further, because context matters. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile, and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses, and this video is for entertainment and educational purposes only. Now, back to the investigation. What made this setup stand out to me wasn't just the list of changes, it was the timing. Almost all of this landed in a compressed window. Regulatory clarity, legal definitions, derivatives expansion, banking guidance. Things that normally take multiple cycles to resolve all snapped into place inside a single one. That doesn't repeat often, and when it does, it usually marks a transition from one phase of an asset's life to another. Saylor isn't alone in responding to this, even if he's the most visible. Large balance sheets don't move on narratives, they don't chase excitement, they move on permission, and once permission exists, they don't move slowly, they move deliberately and at scale. Here's a useful way to picture it. Imagine a city building an airport. For years, all you see is fencing and dirt. From the outside, it looks like nothing is happening. Then, one year the runways are finished, the terminals are wired, air traffic control comes online, and flights don't increase gradually, they surge. Bitcoin's credit layer is that airport. Most retail investors never see it being built. They don't notice zoning approvals or safety certifications. They only notice when planes start landing non-stop. And by then, the entire environment has changed. That's the phase we're approaching, not the headline phase, the operational phase. Another reason this matters is yield. Traditional credit markets are offering increasingly unattractive choices. Long duration risk, low returns, inflation exposure. Digital credit backed by scarce collateral offers, something different. That doesn't mean it's risk-free. Nothing is. But it explains why institutions are even bothering to build this layer in the first place. They're not chasing price appreciation. They're chasing usable collateral in a world starved for it. And Bitcoin, for the first time, fits cleanly into that role. This is why the price stagnation didn't scare Saylor. It confirmed his view. The asset wasn't overheating. It was being prepared. I kept asking myself one question while digging through this. If price had already doubled again this year, would any of this infrastructure have mattered? Probably not. It would have arrived later, after the excitement. Instead, it arrived first. And that single fact changes everything, even though it doesn't feel dramatic when you're living through it. That's the setup. And it's subtle in a way that makes it almost invisible if you're trained to react to candles instead of conditions. Because setups like this don't announce themselves. They don't come with excitement. They don't come with headlines screaming opportunity. They show up as boredom, as frustration, as months where nothing seems to work and every rally fades. And most people interpret that as failure, when in reality it's often the final stage before something structural resolves. These setups don't resolve slowly either. They resolve suddenly, usually after the crowd has already decided nothing is going to happen, usually after the impatient money has left, usually after people stop paying attention because they've convinced themselves they've already seen the outcome. That's not an accident. That's how systems reset. There's another layer to this that almost nobody talks about because it doesn't move price in real time, and it's not something you can trade on a chart. Accounting treatment, balance sheet rules, the boring stuff that determines what large institutions are even allowed to hold. For years, Bitcoin sat in this awkward category, not illegal, not embraced, treated like a speculative asset that punished companies on paper even when it performed well. Every time price dipped, balance sheets took impairment hits. That alone kept conservative treasuries away, not because they didn't believe in the asset, but because the rules made it toxic to hold. When Bitcoin starts being treated as a legitimate long-term asset instead of a permanent accounting liability, that changes the conversation inside boardrooms. Suddenly, it's not, can we survive holding this? It becomes, what happens if we don't? That shift doesn't make headlines, it doesn't cause a pump the same day it happens, but it quietly opens the door for broader Treasury adoption. And Treasury adoption isn't emotional, it's policy-driven, it's slow to start, and then surprisingly sticky once it does. And that process has already started. Not loudly, not with press releases every week, but with policy updates, accounting adjustments, and companies quietly getting comfortable holding something they wouldn't touch a year ago. This is another reason why price action looked so dull, because the people who benefit first from these changes aren't traders, they're allocators, and allocators move differently. They don't chase momentum, they wait for permission. Once permission exists, they act methodically. None of this guarantees a straight lineup. Markets never work that way. Anyone telling you otherwise is selling you certainty that doesn't exist. There will be volatility. There will be pullbacks. There will be moments that make you question whether any of this matters. But it does explain why someone like Michael Saylor is completely unbothered by months of sideways price action. He's not confused by it. He's not frustrated by it. He's not trying to talk it up. Because he's not trading the next candle. He's not managing emotions around a chart. He's positioning for a structural repricing driven by credit absorption, balance sheet normalization, and institutional permission that only happens once an asset crosses a certain threshold. That's a very different mindset, and it leads to very different behavior. When you zoom out and see it through that lens, 2025 doesn't look like a failed cycle at all. It looks like a staging phase, a year where the foundation was poured while almost everyone was staring at the wrong scoreboard. That's why I've never seen a setup like this before. Not because it promises fast money, not because it guarantees anything, but because the order of operations flipped. Infrastructure first, credit first, clarity first, and price lagging behind it all. That inversion is rare, and when it resolves, it usually catches people offside because they've been conditioned to expect the opposite sequence. If you're an all-crypto investor, this matters even if you don't hold Bitcoin directly. Bitcoin sets the collateral tone for the entire market. When it becomes pristine collateral, everything downstream changes whether you like it or not. Liquidity starts flowing differently, risk tolerance shifts, capital moves faster and in larger blocks. Projects that never would have been funded suddenly can be. Assets that used to be treated as speculative get repriced as infrastructure. That doesn't mean everything goes up together. It means the environment itself changes. And environments matter more than individual narratives. So the real question isn't whether Bitcoin goes higher eventually. History suggests it probably does. The real question is whether you're watching the right signals before it does, or whether you're waiting for price to tell you something that already happened months earlier. If you want to sharpen that lens and actually understand how these mechanisms fit together without getting lost in noise or short-term emotion, that's exactly why Cheeky School exists. It's built around structure, around cause and effect, around seeing what's forming before it shows up on a chart. And this is where I'll leave you. If this reframed how you've been thinking about Michael Saylor and this cycle, then you're already ahead of most of the market. subscribe, or watch the next video.